Now that you're managing director of Sundaram AMC, does a CIO stop being a CIO?
When you sell your good idea, what is the probability that you will end up buying another good idea?
So, in one of the events, you spoke about thematic NFL, and you said that there are.
You don't sell down your winners.
And how do you think Sundaram now is?
When we look back and say that why we have been a little bit lagging in scale, there are.
And you've seen multiple bubbles.
Yes.
And since global came out as a topic, do you think that this?
AI as a bubble, and by in terms of
Today, I have with me a very, very special guest. He has almost 30 years of experience in the Indian asset management industry. I have with me Mr. Anand Radhakrishnan, the MD of Sundaram Asset Management Company. Prior to joining Sundaram, he was the CIO of Frankel Templeton AMC, where he was managing a team of experienced fund managers. Sir, it's a pleasure to have you here with me today.
Thank you so much.
So, tell me a little bit about how your experience has been. How did that shape up to your investing philosophy at Franklin? And then we'll get into Sundaram.
Yeah, I joined the industry in the year 1994. That was a great, exciting time from a macroeconomic perspective. A lot of changes were happening. There was liberalization. A lot of industries were getting delicensed, etc. So we were all very excited to think that this is a new era for businesses, and therefore you're going to make a lot of money in investments. So I joined the industry with lots of optimism and hope. But what happened in the next 4-5 years was a very it brought me down to the earth, in the sense that companies actually found very difficult to adapt themselves to the changing circumstances. For example, the import tariffs were brought down from very high levels to low levels. So suddenly companies have to compete with some of the global or regional companies in terms of prices, and that put pressure on their profitability, etc. So markets from the year 1994 till late into 98, 99 didn't go anywhere. And then, of course, the Indian markets participated in the global tech boom, which happened in the year 99 and 2000. For about 2.5 years, we participated, but that also ended in a very deep downtrend when the tech bubble burst. And then it took us more than 2-3 years to recover. So from almost 94 to 2003, of about 9 years, we went through a lot of cyclical ups and downs in markets. Money making was very tough, not easy. And you really have to dig hard and find ideas. Some companies were doing very well. Most of the industrial companies were not doing that great either. So that kind of made us little skeptical on, is it really easy to make money in this market? And it also made us aware of the pitfalls of making bad investments. A lot of companies we thought are very competitive are no longer existing now. What we invested in the year 96, 97, some of them are not existing today. So it also made us acutely aware of trying to understand the businesses a lot more deeply, and what gives these companies certain moats, certain protective cover to exist, and whether they will going to be there for next 10, 15, 20 years or not. That became a primary point of worry for you as an investor. So you're always trying to figure, is this business going to last long enough for you to make money? Because of this particular experience, You constantly kept worrying about that. But subsequently things changed because the challenges also slowly dissipated and companies started flourishing and started making a lot of money, especially from the year 2003 to 2009, 10 kind of a thing. So that period saw massive growth in money making abilities, money making opportunities per se. Number of mistakes also came down.
Is
So
that a sign that it's
i-
too good to be true?
macro opportunities were little more, accidents were little less, and that led to a kind of a some kind of a confidence that you can invest without making too many mistakes. But it was aided by the external environment. The external environment was benign for some number of years before it again turned adverse. The global financial crisis and subsequently what happened in India in terms of banking sector problems, over lending to certain kind of sectors, those things subsequently led to a period of again tougher journey, from where again there was a recovery period. So people who have experienced the recovery period post 2013, 14 till up to COVID, they would have very little, a memory of the earlier struggles, etc. So to that extent, I think our investment thought process is shaped by the kind of challenges that we have faced from a market perspective, the kind of mistakes that you made as an investor, the number of such mistakes that you made. I keep saying that the more the number of mistakes that you make, the better you become as an investor because you get a very varied set of experiences. Of course, you should not become, you should not go bust after making, the mistake should not make you go bust. I call it a risk of ruin. So you don't make such big mistakes that you go out of business. But if you make enough mistakes for you to learn a very wide set of lessons from the market, then the probability of you repeating those mistakes keep going down. So yeah, these kind of thoughts, you know, the the external environment, what kind of challenges it poses on the companies, what do you learn from that, the number of mistakes that you make, your learnings from those mistakes, all that shape up one's approach to investing.
Do you think that you're seeing very similar signs of optimism as what you saw during 1994?
No, I think the cyclicality in the economy has gone down significantly. There was a time where Indian economy was a lot more cyclical, for various reasons. The inflation used to go up and down very rapidly, and therefore the interest rates, the liquidity used to be very tight. The interest rates used to be high. So it used to put a lot of uncertainty in the economic environment. And businesses used to, therefore, the decision making of businesses used to be very short term. And that has changed. A lot of it has changed over time. So I would say that the volatility of macro factors have become a lot less today. I mean, the inflation oscillates between slightly tighter bands. The interest rates move between upper and lower limits, which are more narrower now. The government finances are also more or less in a guided path. So, from a macroeconomic corridor of variables corridor, I think we have become a lot more stable. So, we don't swing from extreme pessimism to extreme optimism that easily nowadays, which is a good sign for a growing economy like India, where you don't want excess volatility of various variables. You want certain reasonable certainty of macroeconomic conditions, which can go a long way for businessmen and other to take certain kind of calculated risks and plan for investing into that future. So to that sense, I would say last 10, 15 years, we have seen gradual reduction in the volatility. Another way to look at it is in any emerging market, over time, the institutions become smarter and smarter over a period of time. Like, for example, banks as an institution, if you take it, the maturity they had in the 90s versus they have in 2000 or 2010 and 20s is a lot different.
After the NPI crisis,
Yes,
much more.
correct. So they have gone through very deep cycles of, non-performing assets, recapitalization, etc. So there is a bit of what we all call it as institutional memory. So if in a banking system there is a lot of institutional memory to not go through this super volatile cycles of extreme lending, extreme risky lending, and then super tightening cycles, then you become a little more moderate. You take more preemptive steps before an accident happens. You don't want to repeat the same old accidents that happened in the year 2013 or 2000 1999 or something like that. So you want to be a little more careful. So that institutional sophistication or evolution that has happened in Indian market is also a factor we should appreciate, that the lot of risks today stand lot more mitigated than what they were earlier. Having said that, post COVID, India did go through a period of a separated period of optimism versus rest of the world. India recovered well post COVID, but it since it didn't overstimulate the economy during COVID, it didn't suffer some of the problems faced by overstimulation, which other economies faced. So to that extent, we came out pretty well out of COVID, and others went through a period of correction, and then they had to come back. But today they are all coming back, and we are kind of moderating a little bit. So that makes it look as if
We are
on a
not.
relative sense, we are not doing that well. But actually, it is not true. Actually, we are doing quite fine.
I read your article on skepticism
Yeah,
and how it's important for an investor to actually have that as a thought process.
yeah.
Do you think that we are taking this whole growth story and growth narrative for granted? Should there be a little bit of skepticism in those numbers?
Yeah, I know. The philosophy that I follow is, I call it like skepticism is better than stoicism. In the sense, skepticism means slightly being doubtful of things. Stoicism is being able to take the good and the bad equally. Now, if you are not doubtful of things, you may end up with some bad outcomes. And only if you are stoic, you will be able to handle it. So, but do you want that or do you want to be skeptic? It's like prevention is better than cure kind of a thing. So why that approach generally has worked for me is like because of the reason I told you earlier. The challenges that you had in identifying companies, opportunities, the kind of accidents or mistakes that you committed always makes you a little bit careful on what you want to bet on and what kind of risk you want to take, etc. But the experience, different set of people have different experiences. At some point of time, people possibly have not experienced extreme bad luck or a very steep drawdown in their wealth or something like that. That makes them super confident of markets, super confident of making very robust investment outcome irrespective of what happens, kind of. It gives them that false sense of confidence. I feel that is a bit of a risk which is very much there in the system. A classic case to understand that is people's understanding of how much money you can lose by buying an overpriced stock, overvalued or overpriced stock, even if it is a very good company. You can buy a bluest of the blue chips, and but if you pay a lot of valuation for it, you end up actually making real real losses over a period of time. The one was that the kind of quality rally that happened between 2017 to 2020, and how all those stocks got valued, and even in 2026, 6 years later, many of those stocks are not giving positive returns, whereas somewhere else you would have made real good returns. So why I say that is, if you are not skeptic of the price that you pay, if you are overcome with the enthusiasm and optimism of this good company that I'm buying, and it doesn't matter what price I'm going to pay, the fact that I'm buying a good company is going to absolve me of all my other sins. I think that is lack of skepticism.
Mm-hmm.
That is too much of optimism. So you always watch what you buy, but you always also watch what you pay for it. I think, I can go on this particular topic, but I would say that you would be only skeptic if you are possibly aware of the other side of this coin. If you are not aware of the other side of the coin, you will be only bullish or mindlessly optimistic. I mean, it is important to be optimistic to make money in this world, but it is also important to know what is in the other side of the coin, so as for you to avoid it, find methods to avoid that particular risk. And hence I say that, look on all sides, have a slightly more well-rounded idea of what you are walking into as an idea, and then, and also walk into ideas which you understand reasonably fine. You don't have to understand 100% of any business, which is not possible. Even the promoters, businessmen won't understand fully well the risks of their businesses. But if you can reasonably understand what drives a company, what drives a business, only then you go into it. Always just keep away.
And this is when you invest. What if somebody is already holding it and then it starts going into overvaluation ranges? At that point of time, how do you look at that side of the coin?
Yeah, there are various, behavioral tools that people advocate to handle those kind of things. I mean, the normal thumb rule is that, you don't sell down your winning ideas very urgently. They will get into periodic overvaluation every now and then, but you never pare them down to zero, just because you have gotten into a good idea, which in itself generally will be rare for any investor. But having gotten into a good idea and at a good price, and it is compounding let's say it's growing at a good growth rate, etc., you don't want to get out of it fully. So you kind of takes you if you want to takes you can want to get some profit. You can trim your positions every now and then add it back when you think that the valuations or something else has become more all right, etc.
But that's a journey. It can take,
Yeah, it
like
can
you
take a
said,
lot of time.
36 years.
Your time horizons has to be relatively long for you to play this game. If you are smart enough, you can totally sell it and buy it back as well. But I would not advocate that, because when you sell something down fully, you never buy it back that easily as an investor, because you are there are a lot of behavioral biases kick in. For example, your original purchase price or the purchase valuations become your anchoring for your next purchase or next. So suppose you have bought a company at 100 rupees, it went to 500 rupees, and then you sold it. Not necessarily you want to buy it back at 100, but you would like to buy it back at 300 or something. Or similarly, if you want to bought a stock at 10 PE and that has become 25 PE, suppose it has come back to 18 PE, will you buy it or will you wait for 10 PE? Our mind has all these, behavioral biases. So we and then end up missing that buying. It may not have gone back to 10 PE again. It may bounce back from the 15 PE valuation, and then we will miss that idea. So that's why I say you never kind of fully sell down your winning bets that easily, because there is also a reinvestment risk.
Hmm.
When you sell your good idea, what is the probability that you will end up buying another
Another
good
good idea.
idea. That you have to evaluate it. If you have something good, that what happens if you end up with a lemon? Even in maybe the money you lose in a lemon may be more than the money you may lose in a good idea. So that is those kind of risks are there. So reinvestment risks are there, and so you need to be very careful. So if you really look at some very good companies, they have compounded well over a long periods of time. But within that, they had periods of overvaluation, undervaluation. You can try to capture those micro cycles as well, or play the macro cycle. Both are possible, but depends. Both requires certain skill levels to play that.
And we were having a conversation backstage where you spoke about grooming people.
Yeah,
How did this philosophy of yours and this learning of yours translate into your tenure at Franklin when you were CIO?
yeah,
How did that
yeah.
foster into your relationships with fund managers?
Before that, I owe a lot of what I learned to my bosses, to whom under whom I worked with. There are people who came along the way, were kind enough to teach me what they had learned um, in various markets, etc. So that left a very lasting impression. That investing is one aspect of investing is to manage people's money responsibly, give them the outcomes that are satisfactory, if not exhilarating, and also be on the right side of regulations, etc. That is all one aspect. The other aspect is, what are the biggest fun of managing money is to work with a bunch of people who are very bright, who understand various businesses well. You are lucky enough to have a team like that. You have to build that team. So if you build that team of a bunch of bright people and who constantly discuss ideas, exchange concepts, uh, s- um, be a sounding board to each other, question and argue against each other, challenge, all that thing, is a part of our growing process. And that is fantastic journey. And I think every investment team, which every team that we choose to work with, should be like that, or we should try to build that. I think I was very lucky enough to have that kind of a team in various places I worked, especially in Franklin Templeton, and because I saw that, and I had a good bunch of professionals to work with. It also became imperative that we give them the right opportunities at the right time so that their careers, you know, blossom and bloom the way, some others' careers like mine did, kind of a thing. So I was always particular about, giving or more and more to the next generation of fund managers or analysts so that they take the responsibility or carry the baton and run it. You can do it if you are very confident that the certain processes that you follow are institutionalized. It's not the individual who is carrying the baton and running, it is the team that is carrying the baton and running. If you have that confidence, then you can freely delegate to the next thing, and you know that people our clients money is not going to be mismanaged or something like that. And luckily, I think I had that kind of a team. And that kind of a team is also what we are building in Sundaram as well. Over the last 2 years, we have tried to, build that kind of a cohesive team that works together, that shares ideas, and where we kind of build talent ground up so that they become good money managers in the future. I am very excited about this kind of a journey.
So how do you deal with mistakes then?
You know,
Because
I,
even during that tenure at Franklin, most of them were new. They were also new to managing public money.
yeah,
So how did that process go in that? Okay, do you give a free hand to say, yeah, you do whatever you want, or
yeah,
how did those risk management processes work? And when it did not work,
yeah.
what were the conversations that were happening then?
So yeah, I think mistakes can happen at multiple levels and also with multiple magnitudes. Like I said earlier, the larger the number of mistakes you commit, the more smarter you become. So it is imperative for you to. No one is born like crazily wise or crazily, investment acumen or anything. They just pick it up. So yeah, the only thing that you should be careful enough is the mistakes that you make doesn't kill you. Doesn't kill you as in not physically, but kill your
Survive another day.
profession. Yeah, kill your profession, kill you professionally, kind of a thing. So that is the risk control thing that you have. The risk control is not should generally I feel should not be in the number of mistakes that you commit. The risk control should be is the money that you bet on such mistakes, and that is where the control should aim to prevent risk of ruin. That is, you don't get ruined while committing a mistake. You have to come out of the mistake, but you will come out stronger. So that is the thumb rule. So now, having said this in English, it's very tough to follow in real life. Certain mistakes will seriously set you back.
And people take it differently.
They will
They
take it
react it
differently.
so they react so
Yeah, some of
differently.
us who are money managers also take it very personally. When you find a winning idea, we think as if it is us who have found it, and therefore we take all the credit. At the same time, when you have a setback, we also take a lot of blame for it, and people can go into a shell, psychological shell, and may find it very tough to come out. So one mistake will lead to another, and another mistake will lead to another, and there is a sequence of mistakes that will collapse your confidence. That is the vicious cycle. The virtuous cycle is, one good bet leading to another good bet, and you are making more money, kind of a thing. So behaviorally, if you commit sequence of mistakes, you have to have a way to get out. Now, you can use sports as an analogy. In some batsman is in bad form, how do they get back into? Is they'll go to the coach, obviously. The coach will say, there is a famous innings of Sachin where he scores a century without doing a cover drive because he was getting caught in the cover while driving. So whoever he can finally they said don't do cover drive. No, cover drive is a bread and butter of any good batsman. To say that I will not do cover drive in this entire innings, but I will come out of my bad patch. It requires a certain discipline, certain conviction that I have 10 other skills for me to bat and come out of this. Similarly, a fund manager should have certain diverse range of uh, sources of competence, which should help them to come out of a bad patch. Suppose you have gone, you bet very strong on, let's say, banking sector, and banking sector has went kaput. Yeah, you don't have to worry about it, but you should have good knowledge about 9 other sectors, and you should be able to pick some good ideas from that. I'm just giving one kind of batting. There are multiple ways. There are sector competencies, sector knowledge is one way of doing it. There is also style. Suppose you bet very aggressively on a very growth idea. And the growth idea is you can kind of go to a slightly less growth, a GARP or a value kind of an idea, and find your money there and bring it back, kind of a thing. So you need to have certain useful tricks on the table for you to come out of the trouble that you are in. But yeah, this someone need to also
Tell
teach
them.
you this particular thing, what kind of a trouble you are in, and therefore what you should not do. And those kind of things, if you work in a team in a good environment, you will get it.
And is it only performance driven then? You say, okay, there's this fund is not performing. Now I need to have a conversation with him. Or how does that conversation part really work?
So there are multiple ways we assess performance, not pure returns or anything.
Correct.
For example, if portfolio manager or investment manager's returns is all made from 2 ideas, and rest of 32 ideas have not made much return, and the 2 ideas also involves a bit of serendipity. some matter of luck, it's not out of skill, then you got to look at it differently. So we call it like, what are your sources of alpha? Where do you make that extra? The more the number of sources of alpha, the better you are as an investment person, investment professional. So when we look at assess fund managers, we do have a rough idea of, is it similarly where you lose money? Have you lost money in 10 stocks, or have you lost money in one stock or two stock? That also matters a lot. So we look at that, the quality of decision making. Do you make, what is it called? Do you make small amounts of money and lose big? Or do you lose small amounts of money and make money big? Which one of these two you think is better?
Second one's good.
Second one
Make
is
more
good.
money, make lesser mistakes.
Yeah. Nassim Taleb says the same thing. When you lose money, keep losing small quantities of money. But when you make money, you make it big. So if you take 10 decisions, 8 of which is you are losing money, and whereas 2 of which are making money, but 8 of which are making only this amount of loss. 2 are making big profits. You are considered as a very good investor. So the quality of decision making, the number of good decisions that you take, and when you get it right, how well you get it right. All these are matters when you assess a good when you assess a fund manager. So, and then again, people have another important thing is when you measure performance. We call it through the cycle performance. When you measure somebody's performance, it should not be from bottom to top and right at the top. Some are called bull market fund managers. Some are called bear market fund managers. Some do really well when things are well, and then they go kaput. You don't hear about them in the down cycle. Whereas some do average on the up way, but kind of really work hard and pull back their performance very well on a down wave. But net they come through pretty well. And market is always up and down cycles. So when you are assessing the performance of the fund manager, they should have at least gone through a couple of such cycles, 2 up waves, 2 down waves of performance, and then you say that, okay, this person is good or average kind of.
So what happens when you disagree with a fund manager when they're making a particular decision? Do you interfere to say, no, I think that this is not something that you should be doing? Or
In normal, I think we need to, once we have given them the responsibility to manage money, you have to let them take decisions. Because, like I said, making mistakes is part of the process to get better. So, if you start meddling in so you have also gone through the same cycle. So you also commit this similar kind of mistakes. So when somebody is doing it, you have to only observe, and possibly, if you don't agree, if you think that something is kind of amiss in that, you can observe it, but you have to say it a little later after the decision is taken, because while preventing is better for the near term, but it may prevent a certain amount of loss that is going to happen by the virtue of the decision. Suppose your view is right and the fund manager's view is wrong, and you are preventing it from happening. There is the prevention of loss, but you are permanently taking away certain evolutionary journey of that fund manager. So it is one thing to do an act and then learn from it. The other thing is, your boss correcting you all the time. I think the value of the second is less than the value of the first. You should therefore allow them to take the decisions, own it, and later possibly help to discover what kind of how it worked and why it didn't work or why it worked kind of analysis. I think in that process is a lot more value additive, I feel. So I normally don't stop fund managers from taking decisions. But if maybe I will just say, instead of, if they are buying a, let us say, 2% position, that's the position they want to buy in a stock or some on an investment. Maybe I'll just tell them, maybe initially you buy 1%, maybe after that you buy in some staggered methods of 20 basis point, and keep gradually adding it. You kind of help them to moderate the execution in such a manner that you bring down the immediate risk of that decision a little bit. You don't negate the decision, you just adjust the execution of decision in such a way that it is beneficial to them as well as it is not harmful in some way.
When do you thumb the table to say, go beyond two?
I never do that. I actually I don't tell. I'm generally not prescriptive of decision making as a rule. I nudge, I prod. We do all kinds of those kind of things to kind of tell people to go in a particular direction, but never prescriptive. I think that money management by itself is a very stressful job, because if you're managing your own money, it's a lot easier. If you're managing other people's money, it's a stressful job. So you don't want to keep compounding that stress. You just have to let people take those decisions and find out. We call it, what is it called? Sizing of a bet is a function of individual fund managers' risk appetite. For example, I may take let us say, I take 1% position in Swiggy, which is a risky stock these days. I already feel that 1% is a risky bet. Somebody may take a 3.5% position and sleep well. That fund manager may not lose sleep even after taking a 3.5% position in that. Whereas I may think that this is a second company in that space, will it work, will it not work, will it turn around, they are making so much losses. I have n number of worries, even for my 1% position. So the individual's ability to be comfortable with certain thresholds of risk are very different. And therefore you cannot be very, very prescriptive. Whereas some other company, I may not feel very risky, whereas that fund manager may feel risky. So it is therefore a very, very individual journey.
Now that you're managing director of Sundaram AMC, does a CIO stop being a CIO?
Yeah, there is a saying in the market. People say, no, you can take a man out of the market, but you can never take a market out of a man or whatever person. So obviously, the temptation to keep playing a more involved role in the investment function is always there, and not because not because you think that you will start to take fantastic decision versus them or something. It is just a habit, and you are used to it for 30 years, and you like that profession, you like that thing, so you are automatically drawn towards taking those decisions. But you have to channelize it in some way where it is useful to you as well as useful to the team. So I do try, to kind of channelize in a way to spend time with individual managers and help them in some decision-making framework, understanding the portfolios in a way they have not thought it out or thought through it, kind of a thing, instead of taking individual decisions. So you start being more like a coach than a manager. So you have to borrow a little bit from the sports world and the analogy from there. And there, a coach doesn't play the game. He helps you to play the game better. So in that sense, I feel I derive a lot of satisfaction in trying to be a coach. Have I become a very good coach? Possibly not. But am I on a journey which I like? I think so.
How is that journey different from CIO to managing director now?
Managing money on a day-to-day basis is an extremely different cup than managing a company. Managing money is like a kind of running a marathon in loops. It never ends because if you are a runner and then if you are in a circular track, not a or a oval whatever track, you keep running. Every day morning you come and you keep running, and you like it. You like running also. So it is a kind of thing which never stops. You know that it's not going to stop, and suppose you had a fantastic 2020, and you want to be 2021 also should be good. You want 2022 also to be good. So every day, every month, every year that you face, you want it to be as good as last year or better than last year. If you had a bad year, you want to come out of those bad years. So you are always planning only in that cycle. So whereas if you step away from that, the challenges are a lot different. So yeah, investment continues to remain a part of the main aspect of the running the company, but you also kind of try to figure out how to tell your story better to the investors. Can I sell my funds better? Can I use technology a lot more productively than others? Or am I using technology in the right way as I should be using? Are we, is our systems safe enough so that investors' money remains safe? So can you reduce instances where you put to risk the safety of investors' money? Some fraud, some cheating happens. How do you minimize all those kind of risks? So people, how do you build good teams? How to have good investment team? Not only investment team, sales team, marketing team, operations team, technology team. There are so many varied kinds of experiences that you go through, and the skill and knowledge levels are also very different. One bunch of team will be extremely skilled in one particular function, they'll have zero thing on other. Somebody else will be similar thing. So you are actually dealing with very, very different sets of people, and you realize one size doesn't fit all. So you kind of need to have, with some people you need to be a lot more prescriptive and assertive. With somebody else you need to be gentle and careful. So you kind of tend to play different roles as a leader for different set of teams or different set of people. And this journey again is very very interesting journey. It's different from being an investment person. The investment person just have to be extremely worried about certain fewer dimensions of decision making. The mental models that that person need to follow are complex, but they are not too diverse. There are not 10 different mental models they need to follow. They need to follow certain few things which are complex by itself, but not too varied. Um, so I feel that it's very different journey and than the doing pure investment management alone.
And Sundaram has a huge legacy.
Yeah.
Do you see this legacy as privilege or pressure?
It's we come with a very what is it called, good historical perspective and mileage. So we want to leverage that as much as we can. We also want to look ahead in terms of growth into the future and modernize things the way we think about the markets, etc. So in some sense, the responsibility to absorb the good things as well as the willingness to change for the future, both are very much part of being such an illustrious brand of the South. And I think everyone in the company is aware of that responsibility. They just don't want to just either be stuck only with the past glory or past performance. Neither they want to cut the umbilical cord and only look at the future either. So they just want to carry the best of the past as well as keep learning from the present so that you become a lot more resilient and more successful in the future.
And how do you think Sundaram now is positioned across other peers in the industry?
So we are, the industry has got more than 40 odd players and we are somewhere in the middle, right in the slightly above the middle part. So we are in terms of size, we are an average size AMC. In terms of vintage, we are as old as anybody else in the system, almost 30 plus. We are going to complete 30 years in the current year, 2026. So from a vintage perspective, from a longevity perspective, we are as good as any other AMCs. When we look back and say that why we have been a little bit lagging in scale, there are two, three, four issues that kept coming back, and hopefully we are fixing some of that. And in the coming next 5 years or so, I think that we will be able to build a good scale, and the firm will move to its rightful place in terms of what it should be within the asset management industry. The industry itself is facing simultaneously the fragmentation and consolidation. This I have explained to some many times. As more and more people enter the industry, there is fragmentation. But because the industry is very competitive, a lot of people want to exit as well. People are not able to build market share. People are not able to become profitable. It's a very it's a scale game with thin margins. Globally too, and in India too, it is slowly becoming like that. It is impossible to have and because it is competitive, you can't charge very high margins into your business, because unless you generate excess returns, you cannot charge people excess fees. So there is a lot of checks and balances which are there, um, um, which makes it very tough. So I call the entry barriers are low, the exit barriers are also low. So some people want to exit as we speak. Now in Sundaram, the way we see it is like we will not exit. So we entered 30 years back, we are still standing there. A lot of people will come and a lot of people will go in the process. We will be a consolidator than the consolidated in the industry. And like I said earlier, we will build the scale, whether it is in MF or in alternates or in other asset classes. We will slowly build the scale based on performance. Some of our funds have given very good performance over the last 5, 10, 15, 20 years. We will tell that, we'll make sure that story reaches more and more people so that people will allocate more of their investment to us and build gradually from there.
So, in one of the events, you spoke about thematic NFOs.
Yeah.
And you said that there are so many outside that you won't be surprised that some thematic fund gets merged with a broad based fund.
Yeah. No, already this is happening, right? Already the regulator is looking at thematic funds and asking questions that whether this thematic fund is different from any other fund that you have, and therefore not giving permissions to launch it. I think it is the correct question to ask, and so fund launches should not be used as a technique to mobilize money and just create just another portfolio that just looks like our existing portfolio. So I think industry went through a very launch of a plethora of thematic funds. Some are genuinely different. Like, some people launched quant-based thematic fund. I also launched a quant-based thematic fund. I feel they are slightly different than the thing. But subsequently, things have cooled off. After this, in 2024 and 25, we saw this. We have seen this cooling off, this particular trend. The general thought process is, if you have existing funds, you got to deliver goods in that very well. You don't need to have too many funds unless it is very different. For example, if I launch a fund tomorrow which gives Indian investors an access to global markets,
It'd be fantastic.
global sectors, I think that is useful for investors, and it'll be a welcome kind of a product to launch. We have a gift city license. If you launch a outbound, multi-country, multi-sector, thematic fund of fund, which feeds into some of the global ETFs, I feel it's a useful product. Maybe already people are launching it. I will also launch. Maybe we'll become good competitors, etc. But if I launch another fund and call it, let us say, Reviving India Fund or something like that, and then make it look like does that mean my existing fund is no longer reviving? It is dead. All the questions come into picture. So we want to be very careful in that, and and only do things which are add value to the client's portfolio, not add value to the fund management company in terms of gathering assets alone, which is important part, but that should not be the primary decision making tool.
And you've seen multiple bubbles.
Yes.
And since global came out as a topic, do you think that this is becoming a bubble scenario for
Yeah.
AI?
The current the discussion centers around AI as a bubble, and by in terms of investments flowing into that space, the money, the quantum of money is big enough for me to make people a little worried as to is it too much money chasing an idea, and therefore the risk of that is pretty high. This happens every time something technology shifts happen. Something new things happen every now and then, and we go through this angst of or worry that are we over investing in it, are we overpaying for this new technology, are we doing the right thing, kind of a thing. My guess is that over a period of time, this has become fairly again sophisticated. Our ability to understand bubbles, our ability to identify over investments, excesses, has become fairly sharp and more clearer. So I think that there are self-correcting mechanisms will kick in to avoid it becoming a super big bubble and from there it explodes, kind of thing. Second is another way to look at it is a bubble happens when one set of people benefit at the expense of other set of people. For example, if AI manufacturers benefit at the expense of AI users, then what happens? There is bubble in the valuation of AI tools manufacturers, and there's a deflation in the value of AI users because these people are paying them money to get that technology, and you are trying to implement it and create value in your business. Suppose you're not able to create value, your value will keep going down, and the value of these companies will keep going up, and that leads to eventually you will become sick enough not to be able to pay for this, and they will also
Collapse.
collapse. That is the logic. Now, is it happening? That is the question that we should ask. Are the users of AI benefiting from it? I think they are. Going by, for example, in the medical field, there are already well documented research papers on that. A well trained AI system can detect certain diseases with a lot more accuracy than human eyes. Similarly, diagnosis wise. So, the use of this is actually leading to reduced error rates, better outputs, more consistent outcomes in some cases, etc. Even in investment, it can help. So I think whoever is advanced in using these techniques in their businesses are getting their edge over their competitors in some of these benefits. So we need to be mindful of that and see whether the users are benefiting. As long as you have enough evidence to suggest that the permeation of this technology in down the leg is actually benefiting the system as a whole, chances that it becomes a bubble and bursts become low. Though I am not an expert in technology, but having looked at some of the past evolution of past tech, the biggest technologies to happen in the world, or let us say, broadband internet, the internet through cables, or World Wide Web, the internet itself, some of the biggest technology things. If you look at it, what has it created? It has created community of people who can learn from each other, share their information. Of course, there are a lot of uses of that. I'm just giving,
Plus multiple
yeah,
industries.
multiple. So you have created a huge renaissance of sorts, which has led to what a world that is today in 30 plus years, ever since 1993, 94, the WWW thing came, World Wide Web came in. We have seen in 33 years a very, very radical change in the positively, in some sense, you would put it. Of course, people have questions about social media, certain negative things about it, but I'm just looking at the positive. So, such technological shifts cannot be dismissed as bubbles. There will be small bubbles of investment, hyper enthusiasm, and subsequent deflation, but that doesn't make the underlying technology something to dismiss. So we need to be careful about that.
And speaking of radical changes, what do you think structurally as an industry we need to change?
In the investment management industry, so I think that is a mad scramble for scale instead of mad scramble for quality of results. I think that should change. The approach to managing money should be of not to manage lots of money, but to manage money well. If that changes slowly, I think. Second is, instead of competing with each other, we'll be competing with other asset classes, etc. So that kind of makes it mutually more successful existence per se. That is something which we should be very careful. Second is, I think this industry has over a period of time have become very heavily regulated industry. There are various reasons for it. I think the primary reason is some of the things that we should have done it ourselves, we could not do it. So therefore, we needed a regular. Suppose I'm just giving an example. Worldwide, people stopped launching closed-ended funds, whereas India was continuously launching closed-ended funds. At some point, the regulator had to come and tell us, please stop launching closed-ended funds because it doesn't seem to be adding too much different kind of value versus open-ended funds. So we needed that pushes and nudges to go in the right. If we can do it ourselves, so in some sense, we'll become a lot more appreciated as an industry that we are kind of taking it upon ourselves to do things better. What are the things we can do? I think, we are just kind of aping the West in terms of going passive. I think we do less of it. It'll be good. though there are people who will argue to the contrary, but I think there are different reasons why it is working there versus why it will be very dysfunctional in an environment like India. So we should be careful about excessive passivization as well. Though we would like to bring down the cost of managing money, but at the same time we cannot drive towards industrialization of this particular industry as well.
And you said that managing money is a very stressful job.
Yes.
How did you spend your time relaxing to survive another day?
Yeah, managing other people's money is actually a big fiduciary responsibility which you need to be very careful about, so that you don't take decisions which cannot let you sleep well or make your life less fun, all that kind of things. I have found big kind of a relaxation in trying to be as rooted to reality as possible. So you kind of go and play your game of a shuttle or a tennis ball,
Are you
cricket
into
or
pickleball?
whatever. Yeah,
Are you into pickleball?
not yet, but some of my friends have gotten into it. So we will do that as well. So idea is to kind of appreciate the other aspects of existence. I think that is a very important thing. Some of us tend to take this too seriously as a 24 by 7 kind of a job. I don't think it is that. A good fund manager, a good investment manager actually spends a lot of time trying to grapple the world outside the Bloomberg terminal that you are sitting in front. I think they should spend that time because a lot of insights come into it, a lot of knowledge come into it. So and it's also a good divergence from your day-to-day work. So find enough time to go out into the real world and interact in that real world. I think that is a very big uh, thing. It's good for the job. It's good for you.
And if you were to give our M2W viewers three pieces of advice to manage wealth through every cycle, what would that be?
Three pieces of advice. Okay, that's I feel that if you want to be successful in investments, you have to uh, invest in yourself primarily. That means you have to acquire certain small micro doses of knowledge or skill at regular intervals. Unless you kind of increase your knowledge, expertise, skill at various things, I feel that your ability to compound your money over a longer period of time will get limited. So learn a new skill, learn a new industry, or learn means understand how that industry has evolved, etc. That is the so invest in your time, invest your time in such a way that you will keep learning small, if not a big dose, small doses of good information. Good information. We should not. We should be able to kind. There are so many things happening in the world. You should know how a EV works. You should know how a battery works. You should know how a internet works. You should know a lot of things like that. I think that is primary thing. Second thing is, I again say this: investing is what you do with the surplus money that gets out of your salary. Okay, now I'm not talking about investment profession. I'm talking people in general. Investing return is not a substitute for your salary. Some people say that, listen, I'm into money, investing in market. I'm making money. I'm not going to work. No, that's the wrong approach. I think the right approach is I have core skills which I'm going to use to earn some money, and that money I am going to invest well. That money which is going to compound, I'm going to use it for certain aspects of life as I evolve into the future. I think people have to differentiate between income that comes out of salary versus income that comes out of investments, and one is not a substitute of the other, unless till you retire, kind of a thing. I think that is the second. What is the other one I can say? Yeah, I do think that to be flexible uh, is most important thing in both investment as well. Just to give an example, our incomes. If you are a very salaried person, maybe it will go through a very linear curve. But if you are a businessman, it will go through ups and downs. But is your spending habits or linear or cyclical? You have to know. You should be flexible enough to make it cyclical along with your income. For example, when the going is good, you may want to treat yourself. When the going is tough, you should know how to tighten your belt. Some people spend well irrespective of when they earn well as well as when they earn poorly. And when they earn poorly, and if you keep spending well, it will dip into your investment pool. And eventually you run out of your savings. So I think people who have slightly more cyclical earnings have to be more also cyclical in their spending habits. If you have a stable earnings, nothing wrong with it. You can have stable spending habits. Um, I have seen a lot of people who don't fine tune their spending to their earnings and then struggle later, kind of a thing.
So, sir, thank you so much for taking out the time and spending your 1.5 hours, 2 hours with us almost. Thank you so much. I wish you and Sundaram all the best, and I'm looking forward to have another conversation with you in the future.
Thank you so much for having me. All the best.
Thank you.